Hello everyone, how are you doing? You are welcome to video 15. As you can see to the top left of my screen, today we are going to be talking about introduction to liquidity. Is liquidity important in the Forex market? What are the forms of liquidity? What are the types of liquidity and how to identify liquidity areas in the Forex market chart? Then I'm going to give you an homework exercise. So again, in video 15, that is this video you're watching now, I'm going to be teaching you introduction to liquidity. Is liquidity important in the Forex market? Do we need liquidity? Why do we need it? What are the forms of liquidity and what are the types of liquidity? And then how to identify liquidity areas in the Forex market. So quickly, I want to check something. That was exactly. Okay. All right. So introduction to liquidity. What do you understand by liquidity? Even before we proceed, or before we go deeper now, I want to ask you, what do you understand by liquidity? So pause this video here and just think about it. What do you think liquidity is in the market? What do you think liquidity is? You know, probably you've seen a lot of my chats and you always see me spot out liquidity, 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 liquidity. So what does it mean? What does this liquidity mean? Have you answered that? All right, then let's proceed. So let's first check Google and check the Google definition of liquidity before I give you my own understanding of what it is. You can just come here, let's try to Google and what is liquidity? And as you can see here, it says liquidity refers to how active a market is. You can see how active a market is highlighted. Then goes further on to say it is determined by how many traders are actively trading and the total volume they are trading. One reason the foreign exchange market is so liquid is because it is tradable 24 hours a day during weekdays. So every single day, Monday, Tuesday, Wednesday, Thursday, Friday, market is open, even in the night. And then people are trading every single hour, every single minute. A lot of people are trading. So it is very liquid. So how is it connected to liquidity? So if a lot of people are trading, how is that connected to liquidity? And as you can see, it says here, one reason the foreign exchange market is so liquid. There we have the liquidity again, liquid. What you understand by liquid is, let's say, water, right? Water is liquid. And then we have solid, like stones and all like that. So they say the foreign exchange market is so liquid. It's because it is tradable 24 hours a day. And then says from the beginning, liquidity refers to how active a market is. So if a lot of people are in, like actively buying and selling their trading, we can say the Forex market is liquid. And then here it says, how do you use liquidity in Forex? Let's see what. So usually liquidity is calculated by taking the volume of trades or the volume of pending trading or the volume of pending trades currently on the market. Liquidity is considered high when there is a significant level of trading activity and when there is both high supply and high demand for an asset, and it is easier to find a buyer or seller. Okay, so these are Google definitions of what liquidity is. But then, ladies and gentlemen, the way we are going to be using liquidity, or the way I'm going to be teaching you liquidity, is going to be a little bit different from what I just explained to you now. Yes, I can agree with the definition that liquidity shows how active the market is, right? That means traders are actively buying and selling, definitely. And then when we see a high level of liquidity, it means there's a high level of trading activity. That can also be correct. A good example can be maybe we have FOMC. FOMC is a major news when it comes to trading fundamental analysis, right? Remember in the video where I was talking about different types of Forex market analysis, I told you about the Forex factory where you can check for fundamental analysis. And then we have some major fundamental analysis news like the CPI, that's Consumer Price Index. We have FOMC, we have NFP, right? So those are fundamental news. And when they are about to drop, we see very like big movement in price. Like for example, now if we come to Forex Factory, okay, and we go to the calendar, every first Friday of every month, we used to have NFP. So this is July 7th, first Friday of this month. By 2:30 my time, there's going to be NFP. NFP is a major news. And I'm going to show you in the next video. I'm going to start with this to show you how this affected the dollar index and how this affected the euro. I'm going to show you in video 16. I'm going to start with this. Okay, I'm going to show you how NFP NFPs are affected. That if I'm making either video 16 or video 17, but this is Tuesday and this news is on Friday. So I might make another video before then. But then if I don't, maybe I get busy and I'm making video 16 after Friday, then I will show you this. But if I'm making video 16 before Friday, then I will be able to show you this, then it's probably going to be video 17. All right. But then we have NFP on Friday, major news. And when this is about to drop, or immediately it is 2:30, you can start to see big candles moving up and down. Price is going very, very fast in one direction. You understand? We can say the market is very liquid at that point because there is fast movement in that area. People are actively buying and selling. The institutions are getting in, taking price in their direction, right? Definitely. And like I showed you in the previous video, I think so, how these big guys manipulate the Forex market, right? So they can take advantage of this news when news is about to drop, and they can use that to their advantage by moving price in their favor, right? So exactly, we can say that is liquidity. The market is liquid at that point in time. But then the way I want you to see liquidity, the way I want you to be able to spot liquidity is going to be quite different from what I just showed you now, right? So I've already given you what introduction to liquidity is from the Google definition, from a Google standpoint, right? But then how do I see liquidity? Okay, first, I always like to say that liquidity equals to um, stop loss. And then stop loss equals to, what's that definition I gave you guys when so I said liquidity equals to, forgot what the liquidity is. Yeah. So liquidity is like, for example, let me give you, I mean, I don't really have a strict definition for what liquidity is, but I just want to give you an understanding of the way I see it, right? So if I'm buying a trade, okay, I'm buying an asset rather, and let's say Euro USD, for example, I'm buying Euro USD and I'm buying at a particular entry. Like for example, now let me bring out this long position too. And I decide to buy Euro USD at 87,500. That's where I'm getting in 87,500. That's where I'm getting in. As you can see, 87,500. And I decide to go in with let's say I decide to go in with 100 pip stop loss. Just saying, what is that 10? Yes, 100 pip stop loss. This is 100 pip stop loss now. And then I want to make 500 pips. Okay. Exactly. So I'm risking 100 pip to make 500 pips. Now, if I am buying this, my entry is at 87,500. Now, this area down here is my stop loss. What this means is that in case this analysis is wrong, in case price does not go in my way, and I'm risking, let's say I'm risking $200 on this trade. So now I'm risking $200 on this trade. Okay. I'm risking $200. I'm risking $200 on this trade now, and I'm getting in at 87,500. Now, what I'm anticipating is that I'm expecting price to come down, fill me, and then reject. But if that does not happen and price continue to sell down, and price gets to my 200, 100 pip SL, what is going to happen is that the broker is going to remove $200 from my balance. So let's say I have a balance of 1,200, and this trade sold down to my stop loss area at 0.86500. The broker is going to remove $200 from my balance. So you see it now, then my balance is going to be at 1,000. I have lost $200 on this trade. And then there is a saying we usually say when this happened, that the market has made you liquidity. So we became liquidity for the institutions, right? So what does that mean when we say, oh, this trade hit my stop loss? Oh, the market has made you liquidity. What do you think that means? So that means our stop loss areas are definitely liquidity areas. Okay, and if liquidity is the same as stop loss now, because if I put my stop loss at this area here and I'm risking a certain amount of money here, this place is liquidity. Liquidity is money. That's how I want you to see liquidity. Liquidity is money. Okay, you can see now that this is different from the other definition of what we're seeing on Google. Somehow related, but not directly related, right? But the way I want you to see liquidity is money. That's it. That's how I want you to see it. So if you're buying here and you put your stop loss here, that place where your stop loss is a liquidity area. And now, do we see money on the chart, or what we see is stop loss? So when you're setting this trade now on TradingView, what you will be seeing is the stop loss. You're not going to be seeing $200. What everybody will see is the stop loss. They won't see the amount you're risking. But then that stop loss area is definitely a money area, right? Because just use yourself, for example, you're getting in here, you have a 100 pip stop loss. That is a 100 pip stop loss. But that stop loss itself is $200 you're risking on that trade. So we can say money itself, or we can say stop loss itself is money. See it now? And we can say stop loss is money. See it now? Stop loss itself is money. So if liquidity is money and stop loss itself is money, then we can say liquidity is stop loss. Therefore, liquidity is stop loss. We are all saying the same thing here. Again, you're getting in at this area. You want to buy. It's the same thing if you want to sell. But this case you're buying, you're protecting your capital with a $200 risk. Because now if you do not protect your capital on this trade, if this trade continue to sell down, this is going to be more than 200. If you get here, this is probably around $400. If you get here, this is probably around $600 you're running in loss. So you want to be able to protect your capital in every trade you're taking. So I'm getting in here, I'm okay risking $200. If this trade does not go my way, okay, broker, please close me at $200 loss. So I can have 1,000 balance left. I can fight another day, right? So this area is my stop loss area. And I'm risking $200 at 0.86500. This is liquidity. We need money. Money is needed to move price. Just like if the institutions want to buy, they need to they go in with very big amount of money. Remember when I taught you smart money and checklist, right? Told you these big guys have so much money that they can push price, manipulate price in their favor. So if they're going to buy, definitely they're buying with a very big amount of money. And it is these institutions that move price. They are the one that move this price up and down. And what they need and what is needed to move price? Money. And what is money now? Liquidity. So liquidity is needed to move price. Remember Google definition, liquidity is how active a market is. So a market can only be active if there is presence of money there. Seeing it now? So liquidity is money. So if you are risking $200 on a trade, depending on whatever you're risking though, and price decide to come for your stop loss, market has made you liquidity. So liquidity equals to money. But then everybody do not see money. We don't see money on the chart. If you send me a markup and I see this, what I'm saying is this is where your stop loss is. What I'm saying is stop loss. In as much as I know that the stop loss is money, and if this trade does not go your way, I can see that you've lost a certain amount of money. But what I'm going to say is this trade eats your stop loss. That stop loss itself is money. That's what I'm saying. That's what I'm trying to say. I'm trying to say this trade has taken you out. You've lost some money. So liquidity is money. Stop loss itself is money. So if they are both the same, it's just like saying that if A, it's just like me saying that if A equals B, okay, and B equals C, I cannot ask you then what is A. So if A equals to B and B equals to C, what is A? Therefore, A equals to B, A equals to C. Same thing, right? If A is the same thing as B, B is the same thing as C. Therefore, A is C. So if liquidity is money, stop loss is money, liquidity is money, or liquidity is stop loss. Same thing. Okay, that's one thing I want you to catch because this topic is very important. You need to understand liquidity if you want to make money from this market. Because this right here will help you with directional bias. This right here will help you with institutional order flow. This same liquidity will help you in understanding structure well, and this same liquidity will help you in swinging trades. Very, very important concept. Now, to the center of my screen, I'm sure you must have been wondering, what is this? I've not spoken about this. This chart here, this image you're seeing at the center of my screen now, this is an example of how a liquidity can look like in a market. So remember, just look at this now. Price sold down. I've taught you the anatomy of a candle, right? This is the low. So price came here, sold, came all the way down here, rejected. Price then bought, came down here, rejected. Price for how many hours? Let's say this is a 1 hour candle. 1, 2, 3, 4, 5, 6, 7, 8. 8 hours, price was expecting a low. What type of market structure is this? I've taught you market structure. Remember, everything I've taught you is interrelated. You need everything. They're all connected. What type of market structure is this? I've explained it to you. This is a consolidation market. Price is going back and forth, up and down. And then what is happening in this area? Remember, in the market structure video, I told you there are reasons why price can consolidate. And I can remember in the video, I told you I will not tell you that yet until we get to the video. Now, this is the video, liquidity. Many reasons why price can consolidate. It's probably because price or the institutions are trying to create liquidity. All right. So I was saying, I have in the market, this is a consolidation type of market, as you can see here, and price is this area here. I wrote this as support, if you remember, right? So this is liquidity. What do I mean by this is liquidity? Price came down here. Remember, price is the movement of price is only possible when there is money, right? So price sold down here, rejected. That means for price to reject here, probably somebody had bought here and then price rejected. When the price came here, came down again, rejected. Came here, rejected. Came here, rejected. Came here, rejected. So in all of this area here, we can see that price is rejecting to the upside. What do you think the institutions are trying to do? Why do we refer to them as smart money? Because they're smart, right? They're trying to they're trying to deceive us to get in that trade. Why? Because if we are like baby traders, we do not know how to trade, and we trade support and resistance. I'm not saying it's bad. There are people that are trading it very well and they're making money from it. But the way I see it is that if I'm buying this now, I am buying at a support level. This means the smart money are trying to induce a lot of retail traders to get in on this trade. Because remember, we have three types of Forex analysis. We have the technical analysis, we have the fundamental analysis, and the third one is the sentimental analysis. So you can look at this now and say, okay, what this is telling you, what this information, the information smart money is trying to show you here is that this is a strong support level. So if you as a baby trader now will be seeing that, okay, if price rejected from here and went up, price rejected from here, came all the way here, is rejecting. This, you can have that conclusion that, oh, this is a strong support level. Let me buy the next touch of this support. And then you get in on the buy here. If you are buying, where will your stop loss be? Now, just think about it. If you're buying this now, where will your stop loss, you're buying this now, where will your stop loss be? Will your stop loss be above or your stop loss be below? Your stop loss would definitely be below. What do you think what do you think you have below this your entry now? Stop loss. And remember, if you come back here, what did I say? Liquidity is money. You are risking a certain amount on this area because you're betting, you're believing that this support level will hold because it has been holding in all of this area. Therefore, let me make it clean. So all of this area now, price is rejecting, rejecting. And you can believe that, okay, since this is the picture smart money's institutions are doing, this is the picture they are forming, they want you to see this picture and believe that, okay, the next touch at this support, I'm going to take a buy all the way to the upside because price has been rejected. So if you do that now, if they finally catch you and you do that, what do you think you're doing? Where do you think your stop loss is going to be? Your stop loss is going to be down here because you're going to protect your capital in case it does not go your way. So just like what you've done, do you know that is the same thing every other trader, majority of every other trader have done, that they're buying here, 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 yeah, and here. So what do you think is building up in this area now? Just tell me, what do you think is building up in this area? The more people keep buying this support, what do you think is building up in this area? That's it. You're right. I just assumed now that you've said it. You are right. Liquidity is building up in this area. This is money building up down here. And that means there's a lot of money building up in this area. Because whoever buys here, let's say the first, you saw it late. Remember, the market is very active. A lot of people are trading. So if you come 10 o'clock, that's when you open up your chart. The market has been moving way before that. And then people are open the chart way before you also, and they've seen this, and then they buy at support. So a lot of people are buying this support now, hypothetically now. Of course, definitely that's what it is, not even hypothetically. People are buying this support. And then there's a lot of stop loss orders in this area. There's a lot of orders here. People are buying with the stop loss down here. What do you think the institutions are trying to do here? They're trying to build liquidity, gather the old money together in one place so they can sweep it and then get in on very big positions and then take price in their favor. So that is why when we see this as smart money traders, we see this as a trap. I'm going to quote what my mentor said of recent when I was watching. I joined one of his live stream on YouTube where it was talking about was giving us some analysis on the indices. It was talking about Nasdaq and so, and then he said, I will not be looking to buy. I will not be looking to go long at equal lows. You see that? He said it is not advisable and it is not wise. It's not something it's going to do, buying at equal lows. Why? Because of liquidity. This is money here. And the institutions are attracted to areas of liquidity. That is it. The institutions, quote unquote, smart money traders, smart money, the institutions, those guys I showed you right on when I was talking about smart money, the institutions are attracted to areas of liquidity. That's it. These guys are attracted to areas of liquidity. They love liquidity so much. Institutions are attracted to areas of liquidity. This is one major point I want you to always remember. The institutions are attracted to areas of liquidity. What does it mean to be attracted to something? What does it mean? What does it mean to be attracted to something? Like you're attracted. That means that that thing is pushing, like it's pulling you to come to that area, right? See, if they say I am attracted to, let's say, like I can say I'm an addict of spaghetti now. What that means is that I cannot do without spaghetti. So once I see where they're selling spaghetti, I'm attracted to that area. I want to buy it. Even though I had spaghetti in the morning, if I see maybe I'm going out and I pass and I see on the signboard that come and buy your spaghetti, but I'm going to sell very like special spaghetti. I can park my car and just stop and go and buy it because I'm attracted to spaghetti. That's what it means when I said the institutions are attracted to areas of liquidity. That means they like to go to areas of liquidity. So you having that understanding alone that these institutions like to go to areas of liquidity, you will not want to be buying at equal lows. You will not want to be buying at equal highs. This is an equal high. You will not want to be buying or selling equal highs or buying equal lows. Why? Because you know that there is liquidity in this area. Quote unquote, people are selling this, putting their stop loss above. And if the institutions are attracted to areas of liquidity, that means there's every possibility that price could just come down here. Once price can sell down, price has swept all this liquidity in this area. Everybody that was looking to buy here has been stopped out. Do you want to be stopped out? Do you want to lose money? Stopped out means they've lost money here. And then this, they've lost money. So now, since you have this understanding of liquidity now, I can understand. You will not understand because I do understand what my mentor said. But now you will understand when he said that it is not advisable to buy at equal lows. It is not advisable to sell or go short at equal highs because of what? The presence of liquidity. You know, I was reading something yesterday in a group I am, right? And then ICT said something. Somebody posted a screenshot of what ICT said. That's the inner circle trader, the big time trader we have in our time. It's very good, right? It said something which I like, and I'm going to quote on this call because it has something to do with what I'm talking about. It said, to answer the concerns of whether the changes coming will make, he said, will make my concept, that is ICT concept, right? Or smart money concept, which is what I'm teaching you, right? Collectively obsolete. So somebody posted something about, I think what started the discussion was somebody posted something about that now that we've entered July, the market is going to change. The Forex market movement is going to change. This and this is going to happen, right? And then ICT said, he said to answer these concerns of whether the changes coming will affect smart money concept. He said, no. And then he backed up his statement by saying liquidity is the lifeblood of trading. Just like we humans cannot do without blood in our body, Forex market cannot do without liquidity. So when I read this, I was like, smart. I like this answer because it backs up what I'm saying. It backs up my trading strategy. It backs up the fact that liquidity is very important in the market. Yesterday, I was teaching on institutional order flow directional bias, and I told you guys that that liquidity is very, very important. So let me continue. He said liquidity is the lifeblood of trading. how it is managed, engineered, used, and purged will not ever change. See that word? Will not ever change. It is not something that is going to go away. Liquidity, this concept of smart money running liquidity, attracted to areas of liquidity, will never change as long as trading goes on continuously or continually now. Liquidity is not a concept that is going to go away. So this is not even a trading strategy. So this is not a trading strategy. This is just how the market works. Okay, this is the foundation upon which the Forex market is built on. So it's not even something I'm going to teach you. I'm teaching you a strategy. No, this is not a strategy. The market is attracted to areas of liquidity. That's it. See now, liquidity. This topic is going to be long. I'm not going to lie to you. So just I want you to catch it well. So liquidity is not something that's going to go away. Okay. So just um, make sure you understand it well. So now that brings us to the next subtopic. Is liquidity important in the Forex market? Is liquidity important in the Forex market? I think I just answered that with a quote from ICT. Definitely, definitely, definitely liquidity is important when it comes to the Forex market. Definitely important. Yeah. So yes, liquidity is very, very important. Exactly. So now that takes us to the third subtopic. What are the forms of liquidity? So we do have the forms of liquidity. We have the types of liquidity. Okay, so let me delete this. Okay, this one is going to be there. Very important. Institutions are attracted to areas of liquidity. Don't ever forget that. So now, what are the forms of liquidity? What are the forms of liquidity? So now we have two forms of liquidity. Liquidity has two forms. The way I see it, the way I'm going to teach you, I don't know if there are more outside there, but then the way I know it is that there are two forms of liquidity. Number one, static liquidity. Number two, dynamic liquidity. See now, we have two forms of liquidity. Number one is the static liquidity. Number two is the dynamic liquidity. Okay, so now what do I mean by static? What do I mean by dynamic? Now, just normal English now. When we say something is static, what does it mean? So let me assume you've answered that. Static liquidity, one place, stagnant. I can also use the word stagnant. Static can be stagnant. Stagnant liquidity, static liquidity is in one place. And then dynamic liquidity. Dynamic, we can also give that as moving. So the liquidity is not in one position. Liquidity is moving. That's it. So static liquidity and dynamic liquidity. So now, how do we spot a static liquidity? How do we spot a dynamic liquidity? So let me do that for you now. So we have static liquidity. Yeah. And then we have dynamic liquidity. Okay, so permit me to do this. Okay, so we have the forms of liquidity. And then we have this here, static, have dynamic. Okay, so we have this as static dynamic, static liquidity. We have that as dynamic liquidity. Okay, so we have static, we have dynamic. Perfect. Okay, so now we have the static liquidity and the dynamic liquidity. Like I said, static is stagnant, right? Then dynamic is something that is moving, right? So now, how do you spot a dynamic liquidity? How do you spot a static liquidity? This is how you spot a static liquidity. Okay, and then we have price comes down, okay, goes up, come down, goes up, okay, and price comes down, goes up, comes down, goes up, comes down, goes up, comes down, and price goes up. Now, this liquidity is static. But when I was teaching you market structure, I wrote it as what? I wrote this area here as what? Support. This is a static liquidity. I'm going to make this 4, and I can change the color to, this is a static liquidity. Now, remember, I just explained it a couple of minutes ago that this area here, a lot of people are going to be buying this. So they're buying this bounce up, they're buying this, they're buying this. And then somebody sees this and say, okay, since price is rejected from here to the upside, rejected here, rejected here. If it comes back there again, I'm going to buy, I'm going to buy, I'm going to buy. What do you think is happening here? What do you think is going on here? A lot of stop loss orders are going to be down in this area, right? A lot of stop loss. So whoever's buying this, they're going to put stop loss here. Okay. Stop loss. I mean, there's going to be a lot of stop loss here. So I'm saying, so we have stop loss. We have stop loss here. Okay. We have stop loss here. Coming. Just want to do. Right. And then we have this. So what I'm saying in essence is that there is a lot of liquidity in this area. That's how I want you to see it. This is a static liquidity. Exactly. This is a static liquidity. That's it. It's a static liquidity. A liquidity that is built in one place. Like if you check this baseline now, if you go to the right, the price is at 0.83632 in this area here. This is a static liquidity. Can you see it now? All of this area here, all the liquidity is below that area. So this is liquidity. And the institutions like to come for liquid. Remember, the institutions are attracted to areas of liquidity. So think of something you are addicted to. It's something you can, like, you hardly can do without. I mean, once you see it, you are always attracted to it. Think of it that way. That's how the institutions add to liquidity. So when they see this liquidity like this, they will come for it. So, but then this is a static liquidity because it is built in one area. Okay, it is just below, or the liquidity is just below that line. That is, this is an example of a static liquidity, and you can either have it above or below. So the liquidity can either be up or down, but then it is static. It's the same thing. Now, dynamic liquidity, remember, this is a moving type of liquidity. So this one is not in one particular place. Right? And then a good example, illustration would be something like this. We have this, okay? and then price is giving us this price come down here, go up to something like this. And then we have price action is just, you know, all right, this is an example of a dynamic liquidity. See, this one is a dynamic liquidity. Why? Because each of the bounds are not in a particular area. This one was here at 81,606. Next one was up here at 83,188. The next one was up here at 84,478. Then we have another one here at 85,963. This is not in one place like this one. So this is an example of a dynamic liquidity. And it is the same thing. We've seen cases where price creates this liquidity, and the next thing we just see is a big move to the downside. This is the institution sweeping all of this liquidity here. You will see it in the markets. This is an example of a dynamic liquidity. So these are the two forms of liquidity that we have. Okay, and then for this one, we're going to have stop loss orders like this. Or let me do this. So this is just like me saying a lot of people are putting the stop losses here, and then many people buy this area again, the stop loss here, and then we have stop loss here also, right? So the institutions like to see all of this. They just take price all the way down, boom, and they just sweep all the dynamic liquidity that's there. So this is a dynamic liquidity. See it now? There's a dynamic liquidity. So if this is a static liquidity and this is a dynamic liquidity, now, next thing we're going to be talking about now is what are the types of liquidity? Okay, what are the types of liquidity? So we've talked about the forms of liquidity. What are now the types of liquidity? What are the types of liquidity? Now there are two. We have two major types of liquidity. Number one is the internal liquidity. Internal liquidity. Sorry, liquidity. And then number two is going to be external liquidity. See it now? We have the internal liquidity and we have the external liquidity. That's it. Internal liquidity, external liquidity. So now, what is, I'm going to bring this here and then we divide that into two also. So we have this area now as internal liquidity. And we have the other side as the external liquidity. Exactly. Internal liquidity and external liquidity. We can come and then divide. Let's change this to black and change it to 2. Exactly. So internal liquidity and external liquidity. So now what do we mean by internal? That is self-explanatory, right? Inside. What do we mean by external? Outside, right? So internal, external liquidity. So these are the two types of liquidity: internal liquidity, external liquidity. Because this liquidity, this internal liquidity can be in two forms. And then this external liquidity can be in two forms. So we can have internal static liquidity. We can have internal dynamic liquidity. We can have external static liquidity. And we can also have external. Can we have external static liquidity? Yes, we can also have external dynamic liquidity. Definitely. Yes. So they are in two forms. Okay, of course. So I think for this one, how do I want to make sure that I'm managing the screen well? Yes, I think, yeah, we can do that. Yeah, definitely. So now for internal liquidity, remember I explained market structure to you and market range, which were the number one checklist, right? Number one is the trend of the market. Number two is the what? The range. Now, if you do not understand the concept of range, you will have difficulty in understanding internal liquidity and be able to spot it. So now, if you know you just watched that range video without having a good understanding, now is the best time to pause this video and just go back to range and watch it again. There's no need to rush, okay? So go back, watch it before you can now come and continue this video, okay? So I hope you're going to do that. But if you have a good understanding of the range, now I'm going to show you an example of internal liquidity, because an internal liquidity is the liquidity that is found inside the range. So an internal liquidity is a liquidity, or is a type of liquidity that is found inside a inside a range. Exactly. You can just make this. Okay. So an internal liquidity is a type of liquidity that is found inside a range. Okay. Now, what do I mean? Inside a range. If you do not understand what range is, go back and watch the video. Okay. Now, inside a range. That means we need to have a range first before we can even be able to spot internal liquidity. So that means we're going to have the trend. Remember, price is giving us what? Higher high, higher high, higher low, higher high. Okay. And when we have this higher high, what do we have? We now have our range, right? We have this as the what? The down range, if you've not forgotten. And we have this as what? Our top range. See it now? So now we have our range. Therefore, we can now be on the lookout for what an internal liquidity is going to look like. You need to be able to see the range first. And then what happens? Price is going to start selling down, give us the higher low, right? And let's say price come down here now, and price now do something like this, like this. Price gives you some kind of consolidation in this area, right? Before you now even went all the way to the upside. What do you think has happened in this area? Price has given you a liquidity in this area. Now, what type of liquidity is this? This is an internal liquidity. It is an internal liquidity because this liquidity now is inside a range. See it now? This is an internal liquidity. So internal liquidity. Exactly. This is an internal liquidity because the liquidity is inside a trading range. But now, what form of liquidity is this? Come back here. Oh, this is a static liquidity. So you see it now? Internal liquidity can be static liquidity, but this is a form of liquidity that is static. And this same internal liquidity can be dynamic. So let me quickly give you an example of what a dynamic internal liquidity will look like. That is a case where we're going to have this, and then we have this, okay, and then we have this, and then as price, remember we have the top range now, the down range, and then we have something like this. And then price just give us something like this. In this case now, this is also an internal liquidity, but this is what type of liquidity is this? This is going to be a dynamic liquidity. Are you seeing it now? This would be a dynamic liquidity, but it's internal. So we can have internal static liquidity, and we can also have internal dynamic liquidity. So an internal liquidity is a type of liquidity that is found inside a range. See it now? But then it can also be static and it can be dynamic. That's it. So let me take this off. There's no space to draw the two. So just have that note at the back of your mind that internal liquidity can be static and internal liquidity can also be dynamic. You know what? Let me write it there. So an internal liquidity can either be static or dynamic. Exactly. So this is it. This is an internal liquidity. It is inside a range. See it now? So let me do this. Okay. And do we have displacements? No. Okay. So I'm coming. Oh, I'm supposed to let's just leave it. Let's just leave it. All right. So this is an internal liquidity, and this is stop loss. There's stop losses down here. In cases like this, the institutions will most likely run on this liquidity. But then I will be teaching you that later when we get to institutional candle. Okay. In as much as price has created higher low, yeah, you can see now the best place to buy is at the higher low, right? So price came here, give us this kind of movement, and then price went all the way to the upside. I'm going to teach you what is most likely going to happen in areas like this later, but then just know that this is an internal liquidity. It is found inside a trading range. Now that takes us to external liquidity. So I'm going to clone this now, bring it here, and we can say that an external liquidity is a type of liquidity that is found outside a range. Outside the range. So let me reduce this to, let's reduce this to 12. Because I want it to contain exactly outside the range. Then we can now bring this and say again that a static and internal liquidity. Oh, sorry, I'm supposed to put this as an external. Liquidity is a type of liquid that is found outside the range, and external liquidity can either be static or dynamic also, definitely. So now let us draw an example of a static liquidity. Now, an example of a dynamic, example of an external liquidity. So in order to draw that, I'm going to do something like this. Price give us this movement down, okay? And then we started to have a high, higher low, and then we have this higher high, okay? And then we have this higher low, yeah? And the price gives us this this higher high, something like this. Yes. So now this case now, price is on his way to, like, price is going up now after price has created this higher low, right? Market structure high, low, high, right? Higher low, right? Now, this liquidity now, remember, where's going to be our range? This is our top range. This is our down range here. And then this is our top range here, right? Exactly. These are our top range here. Oh, exactly. These are top range here. So let me clone all of, let's just copy all of this. I'm going to move them. Exactly. So now let's say we had something like this also, price in this area came down here, and then we had maybe a price action that was like this, just something like this. Exactly. Now in this area now, this is a liquidity here. All of this area is liquidity. But now this is a static external liquidity. Why? Because an external liquidity is a type of liquidity that is found outside a range. See it now, this is a liquidity, but this liquidity now is an external liquidity. Why? Because this is not in the range anymore. This is outside the range. You seeing it? This is outside the range. Our range is this top range and down. So this is inside the range here. But this range, this liquidity is outside. It's outside the range now. So this is an example of an external liquidity that is static in formation. But then we can also have a dynamic external liquidity. And that can be, let me just give you a rough sketch of what that can be. Maybe we have price do something like this, the price do something like this, and price is selling down, my price is selling down, and then price come here, and then price start to give us something like this, higher low, higher high, higher low, higher high, sorry, higher low, and higher high. This is an example of a static, this is an example of an external dynamic liquidity. And many a times price will just run all this dynamic liquidity, and then price just buy all of it. As you can see this now, price is taking out all this liquidity that is here. So this can be one example of a external dynamic liquidity. So yes, I've been able to explain to you static liquidity, dynamic liquidity. These are the two forms of liquidity. Types of liquidities, internal and external. Internal can be static, found inside the range. It can either be static or dynamic. External liquidity is found outside the trading range. It can also be static or dynamic. And in order for you to be able to spot internal and external liquidity, you need to have a very good understanding of market range and how to draw it. If you do not understand that, go back to the video on market range. Okay, so I'm sure it is so market range is coming. Let me check for you quickly. Exactly, video 14, introduction to market trend, introduction to market range. It's going to pop up on the screen now. Introduction to video 14, introduction to market trend, introduction to market range. Yes. So now that leaves us with the last thing, how to identify liquidity areas in the market chart. So we're going to be going to examples now. I'm going to be showing you examples of static liquidity, dynamic liquidity, internal liquidity, and external liquidity. So let me just take a screenshot of this quickly before we proceed. All right. Let us move to looking at chart examples now. All right, so I'm going to take all of this away now. Then we can look at examples, after which I will give you an homework exercise. Right, so let's look at examples. We're done with this. Yeah, so the first example I want to show you is on Euro USD. Right, Euro USD, let's go down to the 1 hour time frame. Euro USD 1 hour time frame. Let us wait for this to load up. So let us come to April, exactly. So remember, I said we have two forms of liquidity, right? We have the static liquidity and we have the dynamic liquidity. And we have two types of liquidity, that is the internal liquidity and the external liquidity. The internal liquidity is found inside the range. Outside, external liquidity is found outside the range, right? All right. So now the first thing we're going to look at for is the static liquidity. So a static liquidity is the type of liquidity that is being built in one particular area, right? So static is in one particular area. Dynamic is moving, right? So let me show you this example. Look at this liquidity, right? We have from this area here now to this area here. All of this liquidity here is a static liquidity, right? Price came here and rejected. So at some point, Euro USD came down, went back up, rejected. Price came back up again to this area. Can you see the same area where price rejected, came down, price came back there and went down again. Then price came up. Yeah. Price came up again, didn't get there, but rejected to the downside. Then price came up again, rejected, and then price came up again, and then price rejected. This is an example of a static liquidity, a liquidity that is built in one particular area. Now, it will not be picture perfect like I showed you or like I drew for you where price is touching it like that, because this is the real market now. It will not be picture perfect, right? Price will come close to it, just like in this area. Price will reject, price will come close to it, and then this area. All of this area is, the idea is that people are selling this resistance, believing that this area, since price is rejected from here, more people will be looking to sell as soon as price is getting close to this area or if price touch it, right? And I told you that this is what smart money is painting this picture. So retail traders, people that do not really know how to trade, right? Be looking out to take a sell with your stop loss above, because if you're selling, you want to have a stop loss and your stop loss is going to be above your entry price, right? So if you're selling, your stop loss is going to be up here. What is smart money doing? What are the institutions doing? The institutions are inducing a concept to you. They want you to sell at this resistance. They want you to get in with your money. And so they can do something like this. You can see what happened after price came down for a while. And then look at what happened. Price rejected and went all the way to the upside. Whoever was selling here now would have taken a loss on this trade. Because if you're selling, if you decide you want to sell here now, you're going to sell here and going to have your stop loss somewhere up here. And look at this, price came down, but then price rejected and went all the way to the upside. So if you had a 20 pip on this trade, even if you had all the way up to like a 60 something pip, you would have taken a loss on this trade. So this is an example of a static liquidity. Okay, this is an example of a static liquidity. So in your homework exercise, this is how I want you to do it. So you do this, show me an example of static liquidity, and you write on it static liquidity. Okay, static liquidity. Come, let me check. Exactly, static liquidity. Now, what type of liquidity is this one here? From this area here. Now, all of this is what? This is an example of a dynamic liquidity. Remember the liquidity that is not built in one particular area, right? Price came down here, rejected, and then we had this area, we had this area, we had this area, and then we had all of this area up here, right? This is an example of a dynamic liquidity. The liquidity is not built in one particular place, right? It is moving. This type of liquidity is moving. So this is an example of a dynamic liquidity. So you're going to write dynamic liquidity. Now, in your homework exercise, I do not want you to send me two of this in one chart. If you are doing the homework exercise for static liquidity, make sure you're only sending me a static. I do not want to see any other type of liquidity there. Okay. Yes. So this is an example of a dynamic liquidity. Okay. Let us see if there's another example of in this area here now, we had this I all the way to this I here. Now, this is not a complete, this is not really a static liquidity. This is more like a dynamic liquidity. But because we do not have equal highs, like it is not really equal. Like we had this price rejected from this area at 1.10735. And in this area, price rejected from here at 1.106. So this area is not really, price did not really reject from this area where price rejected from. So it is not really equal. But when I see, like seeing how price is close to it, I like to call this ones like static liquidity, because the idea is that price, whoever is looking to sell, most likely would have seen the rejection here, see the rejection here, see the rejection here, and will just be projecting that once price can go up, they'll be looking to take a sell down. So to me, this area is also a static liquidity up here. So you can call this one static liquidity also. Exactly. So just put that at the top. So we should have that in capital letter. Static liquidity. So yes, we have this static liquidity, we have this dynamic liquidity, and we have this static liquidity. So now I've been happy to show you examples of a static liquidity and also an example of a dynamic liquidity. So now we're going to go further. I'm going to show you examples of internal liquidity and an example of external liquidity. So an internal liquidity, as you know it now, is the liquidity that is found inside a trading range, right? So we need to be able to spot the range before we can think of drawing the internal liquidity or spotted internal liquidity. So now also in this area up here, this is an example of another static liquidity, right? Because we have price rejected from here, price rejected from here, price rejected from here. This is another example of a static liquidity. So I'm writing this daily liquidity, or you can see this daily liquidity because this liquidity, I spotted it from the daily time frame. That's why I call this the daily liquidity. At times I can have the 4-hour liquidity, I can have the 1-hour liquidity, 30-minute liquidity, depending on the time frame I am on. Depending on the time frame I am on. All right. So now, in order for us to spot the internal liquidity, I told you the first thing you need to know is the range, right? You want to be able to spot the range, and you cannot even spot the range without knowing what the structure is. So it takes you back to checklist number one. What is the trend of the market? So now let us see what was going on in this area. We had this higher high, we had this higher low, and we had this higher high, right? Then price went ahead to break this structure. Right, price broke the structure here. Then we had this as the lower low, right? So in terms of our range now, we have the break of structure. We have the break of structure in this area, right? Therefore, we have this now. This area at the top here is going to be our top range, right? We're going to have this as the top range, and we are going to have this area here as the down range, right? This becomes our down range. So now that we have our range, we can't be able to support our internal liquidity. And I'm seeing this here. Now, all of this liquidity now, this to me is an internal liquidity. But now, what type of liquidity, what type of internal liquidity is this? This is a dynamic internal liquidity. So this is internal liquidity, the liquidity that is found inside the trading range. Now, do you see our price went up? The institutions took price all the way to the upside, took out all the stop losses that were in this area, and then price came up and then started to drop to the downside. So this is price taking out the internal liquidity before dropping. Okay, so internal liquidity is the type of, I would say, when you say an internal liquidity, expect the institutions to come for that liquidity even before you take a trade. So when you are looking to take a trade in a range, in the internal liquidity is the liquidity you want the institutions to capture. Okay, because when we are planning our trade, there are three things I want you to consider. Number one, three aspects of liquidity I want you to put into consideration. Number one, we have the liquidity that the institutions have captured. Number two is the liquidity you want them to capture on their way to activating you, which is an example of internal liquidity. And then the third one is the liquidity you want to join them to capture. So the first one is the liquidity that they have captured. Number two is the liquidity you want to see them captured. That means they've not captured it already, but they're on their way to capturing it. And then number three is the liquidity you want to join them to capture, quote unquote, external liquidity. Because when price is coming in like in a range, you have to draw your range, you spot the internal liquidity. That is the liquidity you want them to capture. So you're going to draw it out and they're going to capture it. Because when they capture it, that can help you have a trade idea. And then when you finally have your trade idea, you're in on the trade, you now want to be on the lookout for external liquidity. That is the liquidity you want to join them to capture. All right. Yes. So now price took out this internal liquidity and you can see our price started to reject to the downside. So this is an example of an internal liquidity. It is found inside a range. And this is an example of a dynamic internal liquidity because it is slopey to the downside. Okay. Yes. So this is an example of an internal liquidity. Now, what is going to be an example of an external liquidity? External liquidity is the liquidity that is found outside a range, which could be a very good example of this area here. So this liquidity, this is a static liquidity. This is also an external liquidity because if you're going to be aiming for this high now, it is outside the range. So this can be an example, one example of an external liquidity here. Another example of an external liquidity could be in this area, right? So we have a range at this top range, this down range here, and we could be looking at, you see all of this dynamic liquidity here, they can, this liquidity here is serving as an external liquidity. Although price came down, must have swept some, but let us see, let me do this coming. All right, so from that down to this exactly. So you see where this down range is, there is also a form of liquidity in this area. This also is an external liquidity. You see this equal lows, price came here, rejected, price came here, rejected. This is a liquidity that is found outside the range. Remember, this is the range and this is the range. So anything inside here is internal. Anything below that now, outside the top range, outside the down range, that is external liquidity. And you can see our price went up. So if you had wanted to take this trade, because remember, if you're planning your trade, three liquidity concepts you want to be on the lookout for, even outside the forms and types. Number one, the liquidity that the institutions have captured. Look at these equal highs here. The institutions went up and captured this liquidity. You've seen it now. The second one is the liquidity you want them to capture. So because I have seen this candle that swept this liquidity, to me, this is an institutional mitigation candle. I'm going to be teaching you that later. And I can plan my trade based off this candle, and I can have my entry somewhere in this area, and I can put my stop loss just at the high. And then the second one is the liquidity I want them to capture. I want the institutions to capture on their way to activating me. So I want the institutions to sweep all of this internal liquidity and therefore activate my order. And that is what happened. And then the third one is the liquidity I want to join the institutions to capture, which is going to be this external liquidity down here, and all of these ones down here, all of these ones down here, which is what we have in this area. You see it now? I'm giving you an example of a static liquidity. I've given you an example of a dynamic liquidity, example of an internal liquidity, an example of an external liquidity, all in one chart. That's it. So now, what I want you to do as your homework exercise is that, so let me write down homework exercise. So this is your homework exercise now. Identify 2 for each, okay? 2 for each examples of a number one, static liquidity. Number two, dynamic liquidity. Number three, internal static liquidity. Number four, internal dynamic liquidity. Number five, external static liquidity. And number six, external dynamic liquidity. So this is your homework exercise. Identify 2 for each examples of number one, a static liquidity. Number two, a dynamic liquidity. Number three, internal static liquidity. Number four, internal dynamic liquidity. Number five, external static liquidity. Number six, external dynamic liquidity. So I should be expecting 2, 4, 6, 8, 10, 12, 12 charts from you. 12 charts. I'm not saying you should on one screen, on one chart, do static and dynamic and then send to me. No. If you're doing static, it should only be static, and make sure you are annotating. Don't just send something for me like this and say assignment 1. I will not accept this. Do it and annotate on it. Let me know. Write it down that this is dynamic. Okay, so I'm expecting 12 charts from you. 2 static, do 2 dynamic, 2 internal, 2 external, 2 internal static, 2 internal dynamic, 2 external static, 2 external dynamic. All right, so that is going to be it for liquidity. If you have any question, please feel free to go to the question group and drop your question there. Once I see it, I will attend to you. All right, so thank you so much. Have a good day. Bye-bye. So let me quickly take a screenshot of this, and then we will be done. All right, so thank you so much. Bye-bye.